Welcome back to Ben's Book Club. Today we are diving into the book, The Little Book of Valuation: How to Value a Company, Pick a Stock, and Profit. This brilliant guide is by Aswath Damodaran, a New York University finance professor who's pretty much known everywhere in the financial world as the Dean of Valuation. What he's done here is taken decades of incredibly dense academic theory and translated it into practical, everyday tools. This explainer is all about handing retail investors Wall Street's toolkit minus the heavy jargon. It's essentially your guide to seeing past the daily market noise and learning how to figure out what a business is truly fundamentally worth.
Okay, let's dive into this, because conflating price and value is literally the single most common investing mistake people make. Notice how they're two completely different concepts, driven by totally different forces. Price? That's set by demand, supply, and the overall mood of the market. It's what traders are obsessing over minute by minute. But value is set by the business's actual cash flows, its expected growth, and the risk involved. When we mix these two up, we end up overpaying for a trendy stock just because we confuse the market's enthusiastic price with the business's true underlying value. A fantastic business can be a terrible investment if you pay the wrong price for it. So, to get an edge, we absolutely have to evaluate the fundamentals.
To find that true value, the first major path is intrinsic valuation, which we typically do through a discounted cash flow or DCF model. Simply put, a company is worth the present value of the cash it's going to generate for its owners in the future. The core logic here is beautifully straightforward. Assets that pump out higher, more stable cash flows are fundamentally worth more. On the flip side, assets with riskier, highly volatile cash flows are worth less. That's exactly why we discount them at a risk-adjusted rate. You're basically asking, based on the actual cash this business can generate, what is it worth to me today?
Now, what's really interesting about this slide is this massive percentage, 60 to 80%. See, when you build an intrinsic valuation model, you're forecasting cash flows for a specific period, let's say 5 to 10 years out. But everything beyond that forecast period gets wrapped up into what's called the terminal value. And in a typical discounted cash flow model, that terminal value often makes up 60 to 80% of the final output. Think about the gravity of that. It shows how incredibly sensitive these models are. Just tiny incremental tweaks to your assumptions about long-term growth or discount rates can completely double or halve your entire valuation. It's a huge reminder that growth is expensive to model correctly, and a single assumption can basically dominate your whole spreadsheet.
Now, an alternative approach is relative valuation. Let's be real, this is the market-based method most investors actually use, whether they realize it or not. You find a comparable peer group, you scale the prices to a common metric, like a price-to-earnings or EV to EBITDA ratio, and then you adjust for fundamental differences in growth and risk. It's asking, how is the market pricing similar businesses? Now, this method is incredibly popular because it's fast and it feels pretty intuitive, but it holds a major hidden danger. Because it relies so heavily on that peer group, it's way too easy to just cherry-pick comparables to justify almost any stock price you want. I mean, if the entire sector is in a bubble, comparing the stock to its peers just tells you it's cheaper than another overvalued stock.
Damodaran warns us very clearly that multiples are shortcuts. They are not substitutes for thinking about cash flows and risk. It's so tempting to pull up a stock screener, see a low PE ratio, and automatically assume, hey, this stock is a total bargain. But every single multiple embeds a story. A low multiple might not be a bargain at all. It might just accurately reflect incredibly high risk or terrible stagnating growth prospects. You can never let the shortcut of a multiple replace the hard work of actually thinking about the underlying fundamentals of the business.
And this brilliantly illustrates exactly why you can't just apply a one-size-fits-all formula to every company. A valuation model has to adapt like a living document depending on the company's stage. If you're valuing a pre-revenue tech startup in the young growth phase, well, you have no history to rely on. Your focus has to be on the total addressable market, the narrative, and the ultimate path to profitability. But as a company moves into mature growth, the dominant value drivers shift entirely. Now you're looking at margins, how much they need to reinvest, and their overall efficiency. Finally, for a legacy industrial giant in the declining phase, the focus shifts yet again to debt levels, dividend stability, and the potential for restructuring. Trying to value a young growth company the same way you value a mature consumer staple, that is a total recipe for disaster.
As we build these models, we also have to address the human element staring right back at us. Damodaran is incredibly candid about this. All valuations are biased, and even good valuations are wrong. We all have pre-existing views, optimism, pessimism, or herd mentalities that quietly tilt our supposedly objective spreadsheets. Bias is structural. Sell-side analysts, bankers, everyday retail investors, we all have incentives.
So many investors actually reverse engineer their valuation just to justify the current market price instead of starting from the fundamentals. Valuation requires admitting that you do not know the future perfectly. It's about getting comfortable working with ranges and probabilities rather than looking for a single guaranteed prediction.
This brings us to a core philosophy of Damodaran's. Every valuation is a story wrapped in numbers. He actually categorizes investors into two camps. First, you have the story people. They naturally grasp the big picture and the narrative of a business, but they desperately need to work on anchoring those exciting narratives to hard, cold cash flow numbers. Otherwise, they're literally just telling fairy tales. On the other side, you have the numbers people. They can build a flawless spreadsheet in their sleep, but they need to realize that numbers without context and narrative are entirely meaningless. If you want to succeed, you have to actively work on your weak side to avoid blinding yourself. Your numbers must support your story, and your story absolutely must be reflected in the numbers.
So the crucial point is Damodaran's practical blended process for the everyday retail investor. It starts by writing out a simple thesis. Why might this stock be mispriced? What is the story? Next, you build a base discounted cash flow model using the simplest inputs possible for revenues and margins. From there, you compare your multiples to true peers to gauge market behavior. Finally, you weigh that intrinsic value against the market price. If the value is far above the price, you've got a potential buy with a solid margin of safety. If it's far below, you walk away. By using both approaches, you stop outsourcing your thinking to analysts who are just using the exact same public data that you have.
I want to leave you with this final, provocative thought. If you can't explain the cash flows, the expected growth, and the risk behind a valuation, do you really understand your investment? Buying a stock without valuing it isn't investing. It's just gambling on price momentum. Damodaran's framework challenges us to stop relying on market noise and to start acting like true owners of the business, constantly evaluating the fundamental drivers of value.
Subscribe so you don't miss an episode.